Gold just reversed $42 in a single session, and 90% of traders out there still think the trend is alive. A single liquidity zone literally wiped out thousands of breakout traders in less than an hour. Welcome to this explainer on ICT market theory. You're about to access the exact mechanical footprints of billions of dollars shifting in the market. We're going to look at how to read the silent signals institutions leave behind right before they flip the market on its head.
90%. That's the percentage of breakout traders currently trapped in the market, basically feeding their accounts directly to the institutions. Look, the crowd always arrives last, right? By the time a trend looks completely obvious to the retail trader, that trend is already dead. The most violent reversals, the ones where price just turns like a beast, they always start in complete silence. They leave absolutely no obvious trace. Well, unless you know exactly where to look.
So you really need to internalize this idea. You're not watching price, you're watching engineered liquidity extraction. What the general crowd sees as a massive breakout is actually a highly orchestrated trap, custom built to extract your liquidity. While retail traders are sitting there staring at red and green candles, just hoping for a continuation, smart money is staring at pools of liquidity. They are engineering the exact moment to pull the rug right out from under them. Which brings us to the first part of our breakdown, engineered liquidity extraction. We're going to decode exactly what smart money is doing while the retail crowd is panicking and hitting their stop losses. And we're not looking at some generic indicators here. We're looking at the raw mechanics of market manipulation. It's really the divide between the retail illusion and institutional reality. On one side, you have the crowd chasing the illusion of news and breakouts. They see a positive headline, a massive green candle, and boom, they jump in. But on the other side, that's institutional reality. Institutions operate by sweeping liquidity and engineering distribution. They literally use the momentum of that news-driven retail money to silently build their opposing positions. Put simply, they use your buy orders to sell. And this brings us to the absolute core of our analysis today, the reversal engine. This is the institutional system used to shift market phases silently, way before the crowd ever notices what's happening. See, reversals never start with price. They start with volume. When you're in a strong trend, you have to look for the footprints of this engine, because if you can read it, you're going to see the reversal 1 to 3 hours before the rest of the market even has a clue. And in trading, that is the literal difference between a blown account and a massive payout.
So let's get into the actual framework of this reversal engine.
We're going to break down the chart using 6 precise layers that smart money uses to trap the crowd. This is the exact step-by-step sequence of an institutional reversal. It's basically a machine built to extract wealth. We've got layer 1, the volume shock. Layer 2, the structural crack. Layer 3 is the transition block, or TOB. Then layer 4, the liquidity sweep. Layer 5, the kill candle. And finally, layer 6, the first pullback. A true, powerful reversal is always going to print these 6 signs. Let's decode each one of them right now. Starting with layer 1, the volume shock. Right before a reversal happens, you're going to see volume spike dramatically. But here's the catch. The price is going to fail to advance. Now the crowd, they think this massive volume is a breakout. They think it's pure momentum. But what's actually happening is smart money is absorbing net buying pressure to engineer a top. They're quietly distributing their positions right into that retail frenzy. This abnormal volume divergence is your very first warning system that a reversal is imminent. Next up is layer 2, the structural crack. Listen, before a trend breaks completely, it fractures. What you're looking for here is a failed high or a failed low. Price attempts to push up to a new high, but the momentum is just weak, and it ends up printing a slightly lower high as the volume completely drops off. Or, on the flip side, it tries to break a low but slams into institutional buy limits and snaps right back. The whole structure begins to crack as market fatigue sets in. The trend is bleeding out, and the reversal engine is officially priming. That brings us to layer 3, the transition block, or TOB for short. Honestly, this is the most critical zone. The TOB is essentially the institutional control room. What you'll see is a sudden, sharp move, followed almost immediately by a harsh rejection, which creates this abnormal, super tight range. This right here is where the sharks are placing their massive reversal orders. They're manipulating the price within this tight block to force retail traders into buying the absolute top or selling the absolute bottom. If you want to catch a reversal, you absolutely must track the TOB. Then we hit layer 4, the liquidity sweep. You have to understand something fundamental here. Without liquidity, there is no reversal. Period. To pivot the entire market, big players need fuel, and that fuel is the retail stop loss. So just before the actual reversal, institutions are going to execute a brutal hunt of session highs or session lows. They literally sweep the liquidity, suck up all those stop losses to fill their own massive orders, and then immediately withdraw. And that leads directly into layer 5, the undeniable footprint, the kill candle. Once that liquidity is swept, the engine fires. Now, the kill candle has 3 very distinct traits. First, it has strong displacement, meaning it's significantly longer than average. Second, it closes firmly against the old trend. And third, it completely engulfs the previous 1 to 3 candles. This kill candle is the undeniable proof that smart money is activating their reversal logic. At this point, the crowd still doesn't believe the trend has changed, but smart money, they're already locked in.
Finally, we have layer 6, the first pullback. Look, amateurs try to catch falling knives, right? Professionals wait for layer 6. You never want to chase the reversal. You execute with precision on the very first pullback back into that transition block. You're basically waiting for price to return to the TOB on low volume, and you want to see a clear rejection candle, like a pin bar or a solid change of character. This is the exact entry that elite traders use. It gives you incredibly low risk, ridiculously high reward, and crystal clear market logic.
Okay, let's talk about precision institutional execution. Because theory is absolutely useless without a ruthless, precise execution plan. We aren't here to just observe the market. We are here to extract from it. So here's your framework for a short setup. Once the kill candle confirms the reversal, you set your entry directly at the TOB zone during that first pullback. Your invalidation point, your stop loss, goes strictly above the layer 4 liquidity sweep, no exceptions. If price breaches that sweep, the setup is dead, period. Your take profit 1 is going to be the nearest internal liquidity pool, and take profit 2 is the next major structural low. It's precise, it's mechanical, and it's totally emotionless. Now, for a long setup, the logic is identical, just inverted. You wait for the structural crock and the downside liquidity sweep. Let the kill candle push the price up, and then set your entry for the pullback down into the TOB zone. You're going to hide your stop securely below that liquidity sweep. Extract your first profit at internal liquidity, and then let the rest run to the major structural high. Boom. You're no longer guessing anymore, you're actively trading alongside institutional order flow. Which brings us to our final section, the smart money truth. If you want to survive in this zero-sum game, you have to fundamentally change how you view price action. You have to stop thinking like a consumer and start thinking like a predator. The market doesn't reverse because of news. It reverses because smart money finished collecting liquidity. Let that sink in. Price moves strictly to where stops exist. See, retail traders constantly chase confirmation. They wait for a moving average to cross or some news alert to flash on their screen. But institutions, they engineer that confirmation. They create the fake breakout just to gather up your liquidity, and once their bags are fully packed, they reverse the engine. It's time to escape the retail trap and master institutional logic. When you combine the volume shock, the structural crack, the TOB, the liquidity sweep, the kill candle, and the first pullback, you suddenly have a complete mechanical advantage over the crowd. If you're studying ICT execution and institutional reversal models, make sure to subscribe for more ICT market theory content as we continue to decode the actual reality of price action. So I'll leave you with this one question. Are you ready to trade the reality? Or are you going to keep being liquidity for the institutions? The reversal engine is running every single day on the charts, quietly shifting billions of dollars. If you want to practice this logic in live market conditions and finally step out of the retail mindset, you'll find the trading account link in the pinned comment below. Stop chasing price, guys, and start tracking the liquidity.